Did retail win? Are the narratives telling the truth or fake news? Did you see all the panic and that there is still more room to go? What can we learn by revisiting Jesse Livermore's statement nearly 100 years ago about campaigns? We'll cover those and more today as we get ready for the jobs reports this week and the day ahead. First, a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. So if we look at what's been happening in the market, and we want to take a very big picture when we think more macro and policy, growth and inflation, uh, and catalysts that are coming. And so if we zoom out here, we have, again, a proprietary indicator that we utilize to assess risk in the market. And as we were coming into the end of the year and into FOMC and the rate cut, we were nearing the end of a cycle. That's what we could see on this. And then we entered transition and a little bit of a drawdown, but then transition. And we told you when we did our video a couple weeks ago that the first area was going to be that line in the sand. And that was sitting around 60.96, 61.03, oscillating between there. That was key for the first leg down. And once we broke that, we've given out daily plans to follow that and to follow the flows in the market so that you are prepared and not panicking when you don't need to at the bottom, but getting out when things change the first time. Like when you go from a two-way road to a one-way road, you want to make sure you're going the right direction. That's what we look for in the line in the sand. We don't want to panic at the bottom. We want to start de-risking once we get under that and we go to a one-way street. And then if we get back over, then we can put more risk on. And so right now we've been more neutral. What is the second key level that we've laid out here is the election. That's been the big area that we laid out again a few weeks ago. If you go back to the 1960s, to the 1930s, 90s, the election levels in popular themed elections are very critical. And we have conflicting factors going into this. And we have a lot of catalysts coming up. So we will start diving into those as we watch what happens here at this 57.92 area today. And we'll go into why this is important from a financial aspect. Again, following the flows and what actually is moving the market and moving the economies. So traders are trying to force the Fed's hand ahead of the minutes by bidding the 2-year and causing yields to drop. And we can see that here on the 2-year note. This happened last summer when we pushed up into September and the first big rate cut, and then the note dropped as the yields would rise. Then again, we pushed traders started betting on rate cuts, and then we had our rate cut into December, and then it came down. And what do you notice is happening again? We're getting a big push as traders start to buy and trying to force the Fed's hands. They start to buy the perspective that we're going to get an interest rate cut. Now, what would cause a cut to occur? And why do we follow the 2-year for this? Well, first, the 2-year is the shortest duration that we're going to monitor for policy decisions. Policy decisions are not made on the overnight financing rate. They're not made on a 6-month or 3-month bill. The earliest note that we watch for is the 2-year. And at the same time, of this, we can follow the dollar as well, and you see the exact inverse playing out. Dollar goes down on the rate cut expectations, then it rises. Dollar goes down, expecting a rate cut. We get the cut, then it goes down. So when rates drop, we are devaluing the dollar. And right now, that's what traders are betting on as well, is that we are going to see a dollar devaluation. And we've seen it go from a high of 110 down to 105. And we have our own levels that we play this game on, but we would get into those with you if you end up wanting to pursue your education further on this. But let's step back and look at the macro. During the campaign, Trump had called for the Fed to cut rates even with persistent inflation. And so watch that rhetoric ahead of the meeting in a couple weeks to step up the pressure to be put on Powell. And while Powell says they are data dependent, really they're market dependent. If you don't understand liquidity in the markets and how that affects bank balance sheets, then we're going to dive into that a little bit as well so that you can understand where this comes from and that the Fed is really market dependent. The market is doing the job for them. So if we think back to last year in January, We rallied from 49.71 all the way up to 61.76. So over a 20% increase last year. Now, what does that do to global markets, monetary supply? Is if we have a $50 trillion stock market, then that now makes $60 trillion or $61 trillion so an increase of 10 to 11 trillion dollars on bank balance sheets to be used as collateral. And standard lending is 80 to 90%. So that means that we don't need to drop rates to increase lending. We now have 10 to 11 trillion dollars that can be lent out for new mortgages, new businesses, anything that people would go to a bank to get collateralized loans on. The problem here is once that starts dropping, now banks, their balance sheets are offline and out of order. And depending on the aggressiveness of the model, some banks can lend on the higher end, some may be on the lower end, some may have different ratios. We don't get into specific banks in this, but as a general rule of thumb, it's 80 to 90%. So we had about a $10 trillion or more increase last year in global monetary supply. So why would you need to print money if you can just push the market higher? And who gets stuck with the bill when it comes down? If we learned anything from the GFC, it isn't that the banks push the limits without regard for safety, and then they take the responsibility. That responsibility falls on the consumer. It's the average individual that gets stuck with a foreclosure, a margin call, a variable debt recall. And if the market drops below these election levels and we get back to a target of 52.45 here, we are going to suck 9 to 11 trillion dollars, almost what we increased last year, is going to come out of the markets. And that is going to be a problem for banks' balance sheets and liquidity. It'll be a liquidity drain. And in most recessions, that's what we see is a liquidity drain. If they've already lent out the money, if they haven't lent out the money, then we won't have a problem. But if they have lent out the money, and we can look at that in the financials and their reportings from the banks and see what their balance sheets are looking like and how their the rate of change of their assets and liabilities has changed from January through December of last year. But if this happens, then the Fed will have to cut rates because we will have to do something to get more money flowing into the economy. And this is why the Fed is always behind when they cut rates and we see the market drop is if you wait for that liquidity crunch, then you've missed the boat as the cascade has already begun. And this is why we're watching that election level so critically because this will take basically since October, so almost 6 months worth of market transactions. And we will be breaking that, which will likely, again, if we zoom out, the last time we had something like that where it was 6 months was 2022. We broke a 6 month cycle and we came right back down to at the time what was the election level from the 2020 election. If we lose this time, that will send us in a much further downside. As long as that holds, we're okay and we're safe. Or if we get under and reclaim it quickly, it's okay. But we also mentioned a couple of weeks ago about Livermore and Carnegie and discussing campaigns, and that a consortium of traders may push a narrative to create hope or instill fear to get the uninformed public to become the unsuspecting volume for their agendas. So we are going to look at both administrations and how they played the game and what playbook they used. So we'll start with the previous administration and job buying Joe Biden, where we were overstating non-farm payroll numbers. And we can see that by looking back at the Bush playbook from 2007 and 2008 ahead of the election, buying jobs so that they would show up and keep the markets pushing higher. But then every month we were seeing the highest revisions. And if we take out the anomaly that was COVID, these are the highest revisions on a year over year basis and month over month basis to the tune of over 500,000 jobs overstated that we've seen since the second Bush term. And that is where our money went to. And that's also where, when we think about what's happening in the markets and in the government right now with getting rid of federal workers, this will have a drastic effect. We had 589,000 overstated jobs so far in 2024 with an average of 45,000 per month, which is more than the 600,000 that typically get added in the last decade. Typically, we've had about 30,000 jobs added from the government side, and then we've used the private sector. We've seen the private sector drop from 600,000 down to 100,000 over the last 2 years, and that was made up by buying jobs with taxpayers' money. And in that helped propel the market higher. It helped keep money flowing in. And how does money flow into the markets that way is when people put money into their retirement accounts, that automatically goes in out of each paycheck, whether weekly, biweekly, monthly, that money is coming in and supporting the market. So now if we start closing the door on that and taking those jobs out of the equation, and we've seen unemployment levels start rising up to 244,000 for initial jobless claims, and we are looking for that to continue trending higher at the moment, then that is going to have a direct effect on the flows coming into the market. So again, we follow the flows. We follow the real money. We are politically agnostic. We are not on either side of the aisle or in the aisle. We are outside the door. We will make money in any administration as we go both long and short, but we want to get you prepared for what's coming. And that's what happened during the previous administration. We were buying jobs to help propel the market higher, to create that sense of security in the market, to keep that money coming in. And on the campaign trail, then Trump was calling for those rate cuts again to try to stimulate that growth, to try to push something to keep that market going higher so banks don't end up in that liquidity crunch. And this becomes a critical factor as we've seen a reduction in the federal workforce. So that's going to be one of the things you want to pay attention to on a weekly basis. Those reports come out on Thursdays, but really this week as we get ADP tomorrow and we get non-farm payroll on Friday, and the non-farm payrolls is likely to be bearish again. But that does not mean we'll go down. All of it for us will depend on that positioning and the flows for that day. So we'll review that, and you can follow our Friday morning video. We'll put that out ahead of non-farm payrolls so we can understand where we are in our market structure. And we always want to follow the money. So if we follow the money again, let's look at, we went from job buying Biden's to President Pump and Sons. And if we look at what happened this week on Sunday, is this tweet is not going to age very well. Announcing strategic reserve on a Sunday when the markets are closed and it's a win for retail. That's the narrative again. So we looked at the narrative on the left side. Now we're looking at the narrative on the right side. And big win for retail. Well, let's take a look. Our model since mid-February had been calling for downside in the market and Bitcoin. And really, our bull market ended back in December. The strong bull market ended here, and then we started entering a transitionary phase, and that's what the colored background is. Again, we've built this model and these tools so that we know what is likely coming. This is saying more downside. And all this was, is it really a win for retail? Everybody who was buying Bitcoin at 93, 94, 95,000 on Sunday as it spiked, got sold into on Monday, as now we're down to 83,440. And we are actually below Friday's close. So anytime anybody who bought on Friday, if they're still bag holding, has lost money. And this is where you want to be very careful in following these narratives, because if you need a narrative and you need somebody to pump up your stock or pump up your crypto to get you to invest, then there's not much we can do to help you, but there's also no rhyme or reason to that. And you are going to get eaten up every day by the institutions that are selling into you. And we saw that with our Bitcoin COT report. Commercials had gone net short last week to 440 contracts net short. So they are actively shorting. So this was actually a move up that was a big win for institutions to continue to short and make 10 to 15% on a lot of Bitcoin futures and a lot of actual crypto itself. And this is where, going back to Livermore and Carnegie, that the market, don't always trust the narratives, because the market is made for liquidity to either gain the product and absorb that liquidity that others don't want and shake them out of their conviction, or create the liquidity by pushing the market higher for us to continue up. That's what we look for in these markets. And that's really what we're going to watch today is, do we get an extra liquidity push down And again, that will then drain liquidity from banks' balance sheets. That's all that the market is this game of liquidity. Where is the liquidity? Is it being stored and warehoused, or is it being sought after in the markets? And so what can you do to begin to prepare for this is really the question. Everybody wants to know, well, how do I use this or what's in it for me? For those that want the lowest hanging fruit, and this is not your focus and your strength, then watch the line in the sand. We put that out each morning and wait until we're over that to find a little more solid footing in the markets as that signals risk compression and is statistically favorable to the upside. Or if you don't even want to have to go that far, then stop watching this video, give your money to a fund manager, and let them lose billions in the washing machine as they've done the last few months. And we've laid out as we watch them get 90% invested only to panic out at 60%, 90% invested, and they're panicking out again. And what was the sign we had more downside this week? When we put out our video is they were 90% invested, and on that drop last week, they didn't go down to 60% like they have been. They stayed at 87%. So they're still holding, and now they pay for that by having to sell even more, even lower. And this is what we want to focus on. We always want to focus on where this money is and how it's affecting the markets. And for those that want a deeper dive, how can you use this? You can learn to do this by yourself by taking our courses. You can learn to do this by not having to wait for the information, and you can sign up for our Discord, or you can go to school, go to university for finance and economics and advanced calculus, and learn to build a model like this based on your own that then you can measure and map any instrument, any indice to understand where the risks lie and where the flows are going. And so ahead of our major catalyst this month. So this week we have jobless claims. Next week we have inflationary data. And the following week we have our Fed meeting. We have a lot of key factors to watch, a lot of key points that are going to dictate where the market goes and that liquidity drain, or that liquidity that comes, that drive to absorb liquidity that comes in the market. And then in 2 weeks, we have OPEX. So we'll have the end of this business cycle. And again, we watch this because as we saw last April, the market topped and into one business cycle, and then we bottomed right into our options expiration, which was the ending of a business cycle before making the next rally. So this period that we're in, our next business cycle closes in a couple of weeks, and we are going to watch for a similar repeat with everything contingent on this key area. Because if we break that, what that's going to do to bank balance sheets, and therefore what it's going to do to the economy, towards jobs, towards flows that come into the market, which is where we focus, is going to be critical for watching. So I hope this video helped all of you. If it has, please like and subscribe. And if you guys have any questions, please ask us in our Discord. We are happy to help and provide any of our charts that we can to give you an added edge. And if you want to level up your trading game and have access to these proprietary tools, then check out our websites for our upcoming courses that start in the next couple of weeks. Have a great day, everybody, and a great week, and we'll see you again soon.